Welcome. Welcome again to Entrepreneurial Finance. The objective of this session is to have an overview of what it means when we look at valuation across projects. Projects and project management is a very interesting area, especially now that we consider that most of the companies and organizations, basically what they are is kind of vehicles or spaces where many projects are happening. So, using this perspective of organizations as a portfolio of projects, we try to see how entrepreneurial finance, or more in particular, the valuation approaches we've been seeing, can help us to understand how those projects work or how we could maybe help some managers to make decisions across those different projects that the organization could be doing or developing in the future. So what we will be doing is that we try to see all what we have seen so far in relation to valuation or investment, like this NPV, IRR, or other elements. How does this work in the context of projects? Also, at this point in the course is a good moment that more and more attention is given to the last assignment, assignment number 6 or assignment number 5, but basically the final assignment of the course. So, what is here relevant is that we take a step back and we try to think, why is interesting from a company perspective or an organization perspective that we look at projects? This is because organizations have limitations in their budgets and resources and capacities. The same thing that happens to most of us. Our time, our energy is limited, and we need to be able to understand which projects deserve more attention, which ones maybe can go ahead without those many resources or investment, and which ones maybe we shouldn't even try to start. So this is the whole story behind these capital budgeting decisions, that we need to decide where do we allocate this capital expenditure, sometimes described as CAPEX. So what is the most usual way to assess the project's values? Is basically to try to look at discounted cash flow. We break the unit of analysis. Instead of looking at the whole organizations, we do it at the individual portfolio of each of the projects. But again, we can use the tool of the discounted cash flow. What we usually would do is that we would then be looking at this economic life of projects. And the economic life is nothing else but the period of time in which the cash flow of that project will be happening. Or as we would say, it's projected to last. So maybe some projects, like building a highway, is expected to last for 20, 30 years, while other projects, maybe setting up an organization like that can supply or provide some services for an event, is a very limited time type of project or organization. Even. It might be lasting a weekend or might be lasting for a week. It's a short time. This is the whole idea that most of the time the economic life of the project is related to also the deterioration of those assets. But it can also be that by definition the economic life of a project is shorter. The classic example is the construction company that has different projects at different maturation stages, and it's essential for them to keep a healthy balance of new projects that are towards the end of their cycle, or projects that are in the middle of the exploitation, the kind of the best years of the project. Similar story happens with pharma companies when they want to look at each of their compounds and maybe the expiration of some of the patents or some of the elements that they have, some of the rights that they have. So one thing, look at the economic life cycle of the project. Another thing is to look at the nature of the risk. We would like to argue that when we value capital projects, we should take into account different types of risks. Some projects are basically what we call replacement projects. Here is the situation where we are just making a substitution of a project that was already existing. We are just replacing it with a similar one. Maybe we are upgrading, we are adding some new equipment, but it's not that it's approaching a new market or using a new technology or any other of those more complex situations. This becomes quite easy to forecast and build a project. This also means that the risk is easier to assess. Expansion projects, those type of projects, they build upon something that already exists. As we say, maybe it's a project that it's looking to increase the market share, expose the company maybe to another potential risk, but it's always like a project that builds upon something already existing. So even if it could be a risky project, maybe the new market gains do not compensate the investment, there is this type of risk, we are assessing things from a departure point that it's something known. So we are building upon something already existing. Last, the harder ones to assess and to calculate is these new product or new service projects. Here it's the situation where most of the times our entrepreneurs are or startups are, is when the founder, maybe they have some experience on that industry, but have no experience introducing that type of products or services. So then the whole discussion is, can we maybe use something that maybe it's a similar product to something already in the market, maybe the founder had a similar experience that helps us a little bit to estimate the risks that they are getting exposed. This is not always easy. For example, if we look at the portfolio of products, again using the case of Fitbit, or you can also use the case of Apple, every year they are launching projects that we could classify as replacement projects. Sometimes they launch projects that are more expansion projects, maybe changing maybe one of their product lines, entering a new market, maybe when, for example, Apple offers a cheaper version of some of their iPhones, trying to enter that market that they have not been able to tap so far. But sometimes, maybe not anymore Fitbit, but Apple still does it, they are launching a new product category or a new type of, completely new type of product offering. This is the moments that those approaches to valuing the project and the risk become more complex. It does not mean that it cannot be done, it just means that it's more difficult to assess. So another way to look at projects is how do they relate to other projects that are already in the organization. So sometimes when, again, with this concept of organizations as an agglomeration of projects, a portfolio of projects, we could maybe look at some of the projects that are what we call independent projects. So the idea to maintain a project or to get it started is completely independent from other projects that the company is working on. Basically, it means that it's not influenced whether that one project goes ahead or one project is working well, our decision to invest or stop in another of the projects. We also have other types of projects. We might have mutually exclusive projects. This might mean that if we go for that project, we are not going ahead with another potential project that we would have in the company. This is, for instance, the situation that if we decide maybe a company that usually can only launch 1 or 2 products a year, if they decide to maybe launch that product that year, they have to wait till the next cycle to launch another version of that product, or maybe a different approach to that market. No? This might happen, for example, in some situations that if you choose maybe to enter into a partnership with a supplier and you decide to approach that supplier and you decide to start working with them to develop that project together, this also means that you will not be able to develop a similar project with another supplier in the next years until maybe that project has gone ahead. There are also projects that could be seen as complementary projects. These are the projects that maybe as you get started in that project, for example, just imagine that you are starting to commercialize an app that is helpful for maybe to assess the health of individuals, you know, and then allows you to track the health and maybe allows you to track the heart rate. But then a project that maybe what allows you to track is the sleeping time. That project becomes a complementary project. So the fact that the heart rate maybe measurement project is going ahead and is working well, another project that also maybe is monitoring other individual health aspects of a person, it's more likely to actually go ahead. You will have already an ability to understand how the dynamics of that project works. So at the end, usually we would resort to simple methods that maybe allow us to calculate each of those projects, how to value them, what is the risk we have, and we could use some of the usual suspects that you already have been seeing, like the net present value or the internal rate of return. There is also other options. For example, the real options approach. This is very useful for especially in projects where when something happens, the value of that project changes, but you don't know if this will happen or it will not happen in the future. Just imagine that you have a project that becomes very interesting if the oil price goes above $50 per barrel, but you are unsure whether this will happen in the future, in the next year or not. So to have a project like this in your portfolio might be interesting if the price goes up, but might be actually worthless if the price stays low next year. So this is when we would like to use these real options. This is something that we cannot do with NPV or IRR. And those situations we need to be able to work with a given scenario, and we cannot be exposed to potential or probability of changes in the future. So most of the times what will happen is that if you want to understand an organization or value an organization and look at their projects, we will end up looking at the NPV. And as you already know, here the key issue is that we agree on a discount rate for the whole period of time of the project, and also that we are able to understand how do they those future cash flows evolve in time. There are other ways. So we were looking now at projecting, but then there are other ways to incorporate risk. And I will just mention those different ways, and I would encourage you to actually look for more resources in case you're interested in any of them. The classic way that we use is scenarios. So when we want to incorporate risk, what we do is that we try to understand which assumptions define each scenario, then we modify those assumptions, and we generate suitable scenarios. Those scenarios need to make sense. So for example, if the scenarios are built upon maybe population growth or income changes or temperature changes or climate changes, then when we put those different assumptions or variables together, they need to be likely. So my meaning here is that don't just randomize the combination of the variables. Try to also that each scenario makes sense when the variables the assumptions are combined and put together. What then you would do is that you would try to calculate the NPV given each of the scenarios, and then give weights on how likely it is that each of the scenarios happen in the next years. And you can change those weights as you get more information. A different approach is the Montecarlo simulations. Montecarlo simulations, the thought here is that what you do is that you assign the probability to those distributions. And then what you are actually trying to calculate is seeing how likely then is that with this combination of probabilities, what is the impact that it would have on your net present value. And this allows us to think ahead on the possible scenarios that we will be also exposing ourselves in a more structured, randomized way. So basically what we here would know is we would try to know that, okay, I know the probability distributions, but maybe I don't know actually the future outcomes of what will happen. But this will help me to understand what might be my company getting exposed to. Finally, another option that we have to incorporate risk is to adjust the weighted average cost of capital, or also WACC. So we also call it discount rate sometimes. Here, as you can imagine, the easier way is to just keep pumping up the discount rate till the moment that we feel comfortable that we have incorporated all potential sources of risk. This is the more, let's say, gross or like a rough way of approaching this. It's good to be a bit more refined and maybe consider scenarios or even Monte Carlo simulations as a more subtle ways to understand where is risk and where is it coming from. There are many options to get more familiar with what we've been looking at today. One of the best options is to look at companies that look like portfolios of projects. And this could be Honeywell, this could be Hitachi, Mitsubishi, but GE is quite an interesting case, as also the portfolio of business units has been changing in time. Now it's a good moment to stop and maybe get familiar with the GE story, their different business units, and how has it changed across time. A change the comments or insights that you get with a colleague or with a friend to see whether those make sense. Finally, to wrap up this session, some tips on how to move ahead with this last assignment, the valuation case that during the next weeks you will be working with. The most important is point number 2. Where do I find the company to do my valuation case? Here the important is that some of the companies that go public, that they do an IPO, initial public offering, is that they release, is a mandatory thing, a prospectus. So this is basically a very detailed company report that includes the business plan, includes financial statements, includes forecast and projections. This is a fantastic place to get started in a valuation analysis, as you will have an overview of the company operations, their management, and this will allow you to start building your valuation and fill up all that forecast, the different templates for the discounted cash flow with more certainty than if you just try to build things based on some reports or from some of the insights that you might be able to get in other places. Again, also a minor comment on this task is that it's good to start evaluation without looking at the specific price or the exact price that the security is trading right now in the stock market. The idea is that you are more unbiased as you approach your valuation. Later on, you will see whether maybe there is something that the market is assuming or looking at that you have like maybe not paid attention. But again, the suggestion is to start without paying too much attention to the current valuation in the market of this company you are studying. This is it for this session. There will be additional material on the different topics, so you can go a bit further on either scenarios or Montecarlo, and actually not also that much on the WACC, because that's the more simple way to do this project portfolio assessment or considerations. Thanks for today.